The story of Europe's economic balance has long been told as if it were settled history. With Germany permanently cast as the continent's industrial heart and smaller Central European states relegated to supporting roles, for decades this narrative felt unquestionable. Germany symbolized discipline, engineering excellence, and economic seriousness. Its factories powered Europe, its exports shaped global markets, and its policies were often treated as the gold standard others should imitate. Hungary, by contrast, was spoken of as a country still in transition, still learning, still dependent on decisions made elsewhere. Yet history has a way of punishing certainty. As the global economy entered a period of deep instability, the assumptions that sustained Germany's dominance began to erode, and the countries once considered peripheral started to reveal unexpected strengths. Chapter 1 begins with this reversal of expectations, because the most important economic shifts rarely announce themselves loudly. They unfold quietly until the old explanations no longer work. Germany's economic model was not weak by design. On the contrary, it was one of the most successful economic systems of the modern era. It combined high-value manufacturing, skilled labor, strong institutions, and access to global markets in a way few countries could replicate. The German economy thrived on precision and predictability. Businesses planned decades ahead. Energy costs were stable. Trade routes were open. Political risk was minimal. This environment rewarded long-term investment and incremental improvement. Over time, Germany became so successful that its model was assumed to be universally applicable, almost timeless. But embedded within that success was a dangerous dependency. The belief that the external world would remain broadly cooperative and stable. Germany's prosperity relied heavily on cheap and reliable energy, frictionless trade, and a global order that discouraged economic confrontation. When those conditions began to disappear, the weaknesses of the model were exposed. The energy shock that swept through Europe did not simply raise prices. It shattered a foundational pillar of German competitiveness. German industry had been built around the assumption that energy would remain affordable and abundant. Once that assumption collapsed, everything else became harder. Manufacturing margins shrank. Long-term contracts lost meaning. Investment decisions were postponed or redirected. Energy-intensive sectors such as chemicals, metals, and heavy manufacturing faced existential questions about whether Germany was still a viable base of operations. What made this crisis particularly damaging was not just its severity, but the lack of immediate alternatives. Germany had committed itself to an accelerated energy transition without fully securing replacement capacity, leaving the economy vulnerable at precisely the moment resilience was most needed. The result was uncertainty. And in economics, uncertainty is often more destructive than high costs. At the same time, Germany's regulatory environment, once praised for stability, became a source of friction. Rules multiplied, compliance grew more complex, and decision-making slowed. Each individual regulation could be defended on moral, environmental, or social grounds, but together they created a system that struggled to respond quickly to sudden change. Businesses found themselves navigating layers of approval processes, reporting requirements, and policy reversals. For large corporations, this meant higher costs. For smaller firms, it meant existential pressure. The famous German Mittelstand, long regarded as the backbone of the economy, began to warn openly that the business environment was becoming unsustainable. When even the most loyal participants in a system begin to question its viability, it signals a deeper structural problem. While Germany was grappling with these challenges, Hungary was operating under a very different mindset. Hungary's leadership never assumed that stability was guaranteed. Its historical experience, shaped by political upheaval and external pressure, produced a more cautious view of the global system. Rather than trusting that international markets would always function smoothly, Hungary approached economic policy with an emphasis on control, resilience, and national interest. This difference in worldview mattered enormously. Once global conditions deteriorated, Hungary did not need to abandon a long-standing belief in permanence. It had never fully embraced one. As a result, its policies were less about maintaining an idealized order and more about surviving and competing in an imperfect one. Energy policy illustrates this contrast with particular clarity. Where Germany treated energy transition as both a moral obligation and a leadership opportunity, Hungary treated energy primarily as a strategic necessity The goal was not to win praise or set an example, but to ensure that households and businesses could function without sudden shocks. Hungary prioritized long-term supply arrangements, diversification, and price stability, even when those choices attracted criticism. From a purely economic perspective, this approach delivered something invaluable: predictability. Companies operating in Hungary could forecast costs, plan production, and commit capital with greater confidence than in many parts of Western Europe. This predictability became a competitive advantage just as uncertainty spread elsewhere. Tax policy further deepened the divergence between the two economies. Germany maintained a high-tax, high-spending model designed to fund expansive social systems and regulatory oversight. Hungary chose a different path. Implementing one of the lowest corporate tax rates in Europe, this was not a symbolic gesture. It was a strategic signal. Told investors that Hungary intended to compete aggressively for capital, jobs, and industrial capacity. Low taxes alone do not guarantee success. But when combined with policy consistency and active government engagement, they can reshape investment flows. Multinational firms evaluating Europe increasingly saw Hungary not as a secondary option, but as a central production hub. The shift was subtle at first, but over time it became impossible to ignore. Labor and education policy also reflected Hungary's pragmatic orientation. Rather than assuming that a highly academic workforce would automatically meet industrial needs, Hungary invested heavily in vocational training and technical skills aligned with manufacturing. This created a labor force designed for the sectors the country wanted to grow. Germany, by contrast, faced mounting labor shortages, demographic decline, and skill mismatches that proved difficult to resolve quickly. Immigration was expected to fill the gap. But integration challenges limited short-term productivity gains while increasing fiscal and social pressure. Hungary's more controlled approach reduced these strains and reinforced its image as a stable, predictable environment for employers. Another defining difference lay in the role of the state. Germany traditionally viewed the state as a neutral regulator, setting rules and allowing markets to operate within them. Hungary viewed the state as an active economic participant, willing to negotiate directly with investors, offer targeted incentives, and intervene when strategic interests were at stake. This approach, often labeled economic nationalism, was controversial but effective. In a world where supply chains were breaking down and capital was increasingly selective, governments that actively competed for investment often outperformed those that relied on passive attractiveness. Hungary understood this dynamic and acted on it decisively. As global economic conditions worsened, the consequences of these choices became more visible. Germany's growth slowed, industrial output weakened, and business confidence declined. Headlines began to question whether Europe's largest economy had entered a period of stagnation. Hungary, despite facing its own challenges, continued to attract investment and expand its industrial base. Manufacturing projects moved forward. Foreign direct investment reached levels that defied Hungary's size. The contrast did not suggest that Hungary had become stronger than Germany in absolute terms, but it did reveal that Hungary's model was better suited to an era of disruption. Chapter 1, therefore, is not about declaring winners and losers in a simplistic sense. It is about understanding how deeply economic success depends on assumptions about the world. Germany assumed continuity and cooperation. Hungary assumed volatility and competition. When the world began to resemble Hungary's expectations more than Germany's, outcomes shifted accordingly. This does not diminish Germany's past achievements, nor does it guarantee Hungary's future success. But it does demonstrate a crucial lesson. Economic models are not judged by their elegance, but by their resilience. In an age defined by uncertainty, the countries that thrive are often those willing to abandon comforting narratives and prepare for reality as it is. That is where the story truly begins. The contrast introduced in Chapter 1 becomes sharper and more revealing once we move beyond structure and into execution. Because economic philosophy only matters insofar as it is translated into action, Chapter 2 is where the divergence between Germany and Hungary stops being theoretical and becomes measurable. It is the chapter of consequences. When global conditions tightened and uncertainty replaced stability, each country responded according to its instincts, and those instincts exposed the strengths and weaknesses embedded deep within their systems. Germany responded cautiously, constrained by consensus, legal frameworks, and ideological commitments. Hungary responded decisively, guided by a belief that hesitation is itself a risk. In moments of crisis, speed is not a luxury. It is a competitive advantage. Hungary understood this early, and Germany did not. Germany's first instinct was preservation of rules, rather than preservation of capacity. Faced with rising energy costs and industrial stress, policymakers focused on maintaining regulatory coherence and long-term climate targets, even as short-term competitiveness eroded. Support packages were debated, revised, delayed, and narrowed by political negotiation. Businesses, meanwhile, needed clarity, not deliberation. Factories operate on timelines measured in weeks and months, not parliamentary cycles. The result was a growing gap between policy intent and industrial reality. Companies were forced to absorb costs while waiting for solutions that arrived slowly or not at all. Hungary took a different path. When pressure mounted, the government moved quickly to stabilize energy prices, cap volatility, and offer targeted relief to key sectors. These interventions were not elegant, but they were effective. They sent a clear message. Production would be protected. This difference in response speed had cascading effects. Capital is highly sensitive to momentum. Once investors perceive hesitation, they begin to reassess risk. Germany's prolonged debates signaled uncertainty at precisely the wrong moment. Hungary's rapid interventions signaled control. This distinction mattered enormously to multinational firms deciding where to expand or consolidate operations. Investment is not driven by sympathy. It is driven by confidence. Hungary cultivated confidence through action, while Germany allowed doubt to accumulate through delay. Supply chain realignment further amplified this divergence. As global trade became less reliable, companies sought to shorten and secure their production networks. Central and Eastern Europe gained strategic relevance as a manufacturing corridor connecting Western Europe to global markets. Hungary positioned itself at the center of this shift. Infrastructure investment, logistics development, and industrial zoning were aligned to attract large-scale manufacturing projects. Germany, already established, struggled to adapt its existing industrial footprint to new constraints. Legacy systems are efficient in stable environments, but rigid in changing ones. Hungary's relative newness became an advantage, allowing it to design capacity around current realities rather than past successes. Another decisive factor was Hungary's clarity in communication. Economic policy is not only about laws, it is about signals. Hungary communicated its priorities consistently: industry, investment, and national economic strength. There was little ambiguity. Germany's messaging, by contrast, was fragmented. Different ministries emphasized different goals, often pulling in opposing directions. Climate leadership, social expansion, fiscal restraint, and competitiveness were all presented as simultaneous priorities, without a clear hierarchy. To investors, this suggested future policy conflict. Hungary's single-minded focus suggested continuity. The role of foreign direct investment in this chapter cannot be overstated. While much of Europe experienced declining inflows, Hungary attracted large-scale commitments in automotive manufacturing, electric vehicles, battery production, and advanced electronics. These were not speculative investments. They were long-term bets involving billions of dollars and decades-long timelines. Such investments require faith and policy stability. Germany, paradoxically, began losing marginal investment not because it lacked capability, but because it appeared undecided about its own industrial future. Hungary appeared certain, and certainty is rare in modern economics. Fiscal strategy also reveals an important contrast. Germany remained committed to strict fiscal rules, even as economic conditions deteriorated. While discipline has long been a German strength, in this context, it limited flexibility. Hungary allowed itself greater room to maneuver, accepting short-term criticism in exchange for long-term capacity preservation by cushioning households and businesses from shock. Not Hungary reduced the risk of social unrest and industrial collapse. Germany's restraint preserved balance sheets but weakened momentum. In a downturn, momentum often matters more than perfection. There is also a psychological dimension to this chapter that is often overlooked. Germany's economic culture prizes caution, consultation, and incrementalism. These traits are strengths in stable periods, but liabilities in crises. Hungary's political economy is more centralized, is more willing to tolerate risk, and less concerned with external approval. This cultural difference influenced outcomes as much as formal policy. Hungary accepted reputational costs in exchange for material gains. Germany protected its image, sometimes at the expense of its factories. By the end of Chapter 2, the pattern is unmistakable. Germany did not collapse, but it slowed. Hungary did not become dominant, but it surged relative to expectations. The gap between them widened, not because Hungary discovered a miracle solution, but because it aligned policy, speed, and messaging around a single objective: economic survival and competitiveness in a hostile world. Germany attempted to balance too many objectives at once, assuming time was on its side. It was not. This chapter is ultimately about execution under pressure. It shows that in modern economics, the ability to act decisively often outweighs the elegance of long-term planning. Systems designed for stability struggle in volatility. Systems designed for volatility endure. Hungary built its model with disruption in mind, and when disruption arrived, it functioned as intended. Germany built its model for permanence, and when permanence disappeared, adaptation proved slow and costly. That is the deeper lesson of Chapter 2, and it sets the stage for the final question this story raises: whether Europe's largest economies are capable of learning from smaller ones before the cost of delay becomes irreversible.